For thousands of years, one of the most successful groups of wealth builders in history didn't use spreadsheets. They didn't have access to Bloomberg terminals or real-time trading apps. They used a rule so simple it sounds like a nursery rhyme. 33% in land, 33% in business, 33% in reserves. It's called the Jewish wealth ratio, or the 33% rule. It comes from the Talmud, written over 1,500 years ago. The original text said, a man should always divide his money into three: 1/3 in land, 1/3 in commerce, and 1/3 at hand. And here's what nobody tells you. Most people are terrified of this strategy because it requires something modern investors hate: sitting on cash. We've been told that cash is trash. We've been told that if our money isn't working, we're losing. We've been conditioned to fear inflation so much that we sprint toward risk just to feel safe. So we go 100% into the stock market, or 100% into our houses, and we wonder why we feel like we're walking a tightrope every time the news mentions a recession. We are lopsided. We are fragile. We are one market shift away from a total wipeout. I looked at this ratio for a long time and thought it was outdated. I thought it was a relic from a time when business meant trading spices and land meant a literal farm. However, the 33% rule isn't about maximizing your gains this quarter. It's about making sure you're still standing 20 years from now. It's about the philosophy of survival. In the world of finance, everyone is obsessed with the ceiling. How high can we go? How fast can we get there? But the 33% rule is obsessed with the floor. It asks, how hard can I fall without breaking? Think about your wealth as a tripod. If you put all your weight on one leg, say your business or your stock portfolio, and that leg breaks, the whole thing collapses. Your lifestyle, your future, and your peace of mind all hit the ground. But with 3 equal legs, you are mathematically stable. You can lose an entire leg and the tripod still stands. It might lean, but it won't fall. Let's break down the first leg. Land. In the modern world, this is real estate. It's the dirt under your feet, but it's more than just a house. It is the anchor of your wealth. Land is the only thing they aren't making more of. It is tangible, it is finite, and most importantly, it is a physical reality in a digital world. When the stock market is flashing red and numbers on a screen are disappearing, your land is still there. The beauty of land is its simplicity. It doesn't care about inflation. In fact, it usually eats inflation for breakfast. As the value of the dollar goes down, the value of the dirt and the wood and the bricks usually goes up. It doesn't care about a CEO's bad weekend or a corporate scandal. It provides a roof, it provides rent, and it provides a sense of permanence. For the person following the 33% rule, land isn't a speculation. You aren't trying to flip it for a quick profit. You are holding it as a foundation. You are looking for properties that produce cash flow, rental income that arrives whether you get out of bed or not. This is the passive part of the tripod. It's slow, it's boring, it's heavy, and that is exactly why you need it. It creates a barrier between you and the chaos of the financial markets. Now let's talk about the second leg, business. This is your engine. This is where you take risks. In ancient times, this meant commerce, buying goods in one place and selling them in another. Today, it means owning productive assets. This is your stock portfolio, your private equity, or your own small business. This is the part of your wealth that has the magic of compounding. It's the part that grows while you sleep. Business is where wealth is actually created. You are betting on human ingenuity. You are betting that people will continue to want better products, faster services, and new solutions. When you buy a share of a company, you are hiring thousands of people to work for you. You are participating in the growth of the global economy. This leg carries the most risk. Businesses fail, industries get disrupted, markets crash, but this leg also carries the most reward. This is the part of the 33% rule that allows for explosive growth. While land provides the floor, business provides the ceiling. It's the part that turns a modest savings account into a fortune over several decades. It is the engine that drives the vehicle forward. But here is where the 33% rule gets radical, the final third: reserves. This is your at-hand money. It's your oxygen. And this is the part everyone gets wrong. They see 33% sitting in cash or liquid assets and they think it's a waste. They see a high-yield savings account or a short-term bond and they see lost opportunity. They think about the 8% or 10% they could be making in the stock market and they feel a physical pain in their chest. But reserves aren't just for emergencies. They aren't just for when the water heater breaks or the car dies. Reserves are for opportunity. The 33% rule understands something that modern finance tries to ignore. Markets are emotional. Humans are prone to panic. When the stock market crashes, and it will, the person who is 100% invested is paralyzed. They are watching their life savings melt down. They are terrified. They are the ones selling at the bottom because they can't handle the pain. But the person with 33% in cash is the only one who isn't panicking. They aren't looking at the screen with fear. They are looking at it and salivating. They are the ones buying everyone else's investments at a 50% discount. They have the dry powder to take advantage of the chaos. In the 33% rule, cash isn't lazy. Cash is a call option on every other asset class. It is the ability to strike when the iron is cold. It is the freedom to stay rational when everyone else is losing their minds. The 33% rule assumes the world is unpredictable. It assumes that at some point one of these legs will fail, and when it does, the other two are there to hold you up. It's not a hack. It's not a secret formula for 1000% returns. It is simply the geometry of survival. Most people quit the game because they get wiped out by one bad cycle. They go all in on the steep part of the curve and forget that curves can bend both ways. They get drunk on a bull market and start moving their land money into business money because they want to get rich faster. They stop keeping reserves because they think the party will never end. But the 33% rule is a discipline. It requires you to rebalance. When your stocks, business, do incredibly well and they now make up 50% of your wealth, the rule tells you to sell. It tells you to take those profits and buy more land or fill up your reserves. It forces you to sell high and buy low. It prevents you from getting caught in a bubble. It also protects you from the psychological trap of all or nothing. Most investors are either all in or all out. They are either aggressive or terrified. The 33% rule allows you to be both. You can be aggressive with your business investment, knowing that your land investment is secure. You can be calm during a real estate slump, knowing that your business investment is still producing. This creates a shift in how you see the world. You stop obsessing over the daily fluctuations of the S&P 500. You stop checking Zillow every week to see what your house is worth. You start looking at your wealth as a holistic system. You ask, is the tripod balanced? Now, let's look at why this is so hard to do in the modern world. You see, we live in an age of specialization. We are told to pick a lane. We have real estate gurus who say stocks are for suckers. We have stock market experts who say real estate is too much work, and we have gold investors who say everything is going to zero. But the 33% rule ignores all of them. It is the ultimate middle path. It recognizes that no one actually knows what the future holds. It recognizes that real estate can have lost decades. It recognizes that businesses can go bankrupt, and it recognizes that currencies can lose value. By holding all three, you stop trying to predict the future and start trying to prepare. Think about the historical context. The people who followed this rule lived through empires rising and falling. They lived through wars, plagues, and technological shifts that wiped out entire industries. And yet, by keeping their wealth in these three distinct investments, they were able to pass that wealth down for generations. Land stays land. Business evolves, and reserves provide the bridge between the two. If you are starting from zero, the 33% rule gives you a roadmap. You don't have to hit all the percentages on day one. You might start by building your reserves, but once you have your at-hand money, you move into the business leg, maybe through the low-cost index funds. And as that grows, you eventually move into the land leg. The goal is to move toward that 33-33-33 ratio over time. The final piece of this puzzle is the why. Why bother with such a rigid structure? Why not just try to get the highest return possible? Because wealth is more than a number. Wealth is a state of being. It is the ability to sleep through the night. It is the freedom to make choices that aren't dictated by fear. The 33% rule creates a psychological buffer that most people never experience. When you know that you have enough cash to survive for years, and you know that you own a piece of the earth that will always be there, you are able to take much smarter risks in your business life. You aren't desperate, and in the world of money, the desperate person always loses. The person who follows the 33% rule has the luxury of time. They don't need their stocks to go up tomorrow. They don't need their property to double next year. They are built for the long haul. They are playing a game of decades, not days. Most people quit because they get tired. They get tired of the volatility. They get tired of the 2 steps forward, 1 step back nature of compounding. The 33% rule removes that exhaustion. It smooths out the ride and turns the roller coaster of finance into a steady, inevitable march toward independence. It turns wealth from a gamble into a fortress. It ensures you never have to quit, and it makes you indestructible. The 33% rule is a reminder that the oldest advice is often the best advice. It reminds us that while technology changes, human nature does not. We still fear loss, we still crave growth, and we still need shelter. Because the goal isn't just to get rich. The goal is to stay rich. And that is the 33% rule in action. It's not a hack. It's not a secret formula. It is simply what sustainable growth looks like when you value survival over speculation. Well, thank you guys so much for watching. I hope you enjoyed this video, and please do subscribe if you haven't, and like the video. With that said, have a great day, and see you tomorrow in the next video.